When it comes to investing, generally speaking, the more simple your investments are, the better you will probably do over time. And this is for a few reasons. It basically minimizes you from picking an investment that doesn't do well, and it doesn't allow you to keep flipping back and forth between investments. So I myself have 4 ETFs. I have VIG QQQ in my growth portfolio. And in my income portfolio, I do also hold a bit of SCHD and JEPI. All in all, I do hold some pretty popular ETFs, but a lot of people would say that even this is too many ETFs. So today I'm going to be speaking about 3 separate ETFs that you could basically invest in just one at a time, choose, and then put all of your money into those investments. And that is a common thing that many investors do. And they basically call it something like VT and chill, VTI and chill, or VOO and chill. Right? So for example, on online forums, pretty much the phrase comes up and there are quite a few postings regarding a VOO and chill or a VTI and chill. And these are actually very common strategies that really good investors do over time. Basically, high income earners or even just average income earners like myself, they'll choose one ETF and let it ride. Now I'm going to begin to speak about these 3 ETFs, but before we do that, if you could give this video a like if you appreciate the content and subscribe if you're not already subscribed for future content. This will help this video get out there to a wider audience and basically inform people about the simple investment there is. And then also you will basically get updates for future videos as well. So again, it would be greatly appreciated, and let's get into it. So ETF number 1, and this is going to be VOO, or the Vanguard S&P 500 ETF. A really cool thing about this ticker symbol is that the Roman numeral for 5 is V. So if you look at it like lettering, it is a 500, the Vanguard S&P 500 ETF. And that is a pretty cool little thing that they did there, I think, of course, because it goes along with Vanguard and VOO. Now, the S&P 500 is the 500 largest companies in the United States. It is an index that tracks those companies. So if you look at the product summary here, this is pretty much the gold standard for investing. It invests in stocks in the S&P 500 index, representing 500 of the largest companies in the United States. And the goal of the ETF is to track the index return as closely as possible. So this is going to be a relatively diverse index with 500 companies, of course, and this is going to be weighted by market cap. This has a very low expense ratio, 0.03%, one of the lowest expense ratios out there when it comes to ETFs. So definitely a gold standard among the group of ETFs that track the S&P 500. There are other ETFs out there that pretty much offer a similar expense ratio, but there are also others that have a bit of a higher expense ratio. Now, the way this breaks down by industry is, of course, information technology is the largest component of it. A lot of the US economy is based on information technology, so you would expect that. And then we also have things like financials, consumer discretionary, healthcare that come in all tightly grouped together, but they are not even a half of what information technology is. So just be understanding that a large amount of what you are going to be investing in with this ETF is information technology, which some people don't enjoy, but it is somewhat fine because these companies are such behemoths, and that is, of course, where most of the growth is right now. So some of these companies, the top 10, Microsoft, Apple, Nvidia, Amazon, Facebook, Google, Berkshire Hathaway, Google again, Eli Lilly, and Broadcom. So pretty much you just definitely see the top heaviness of these top 10 here related to technology. And of course, even Berkshire Hathaway, you can argue, is very heavily on technology because a large portion of that company is invested into Apple itself. So you really only get one company, Eli Lilly, that is not tech in the top 10. You could argue Amazon is not a technology company, but a large part of the revenue, I believe, comes from Amazon Web Services. So essentially the entire top 10 pretty much of this ETF is in large, well-developed information technology / technology companies as a whole. All right, next up, VTI, the Vanguard Total Stock Market ETF. This is going to be for investors that want even more diversification than the top 500 largest companies. This is going to include those large, mid, and small cap companies. In case you are worried about underperforming of huge mega companies, this is going to have a tilt toward the mid and small companies. So this ETF seeks to track the performance of the CRSP US Total Market Index, large, mid, and small cap equity diversified across growth and value styles. This is also a very cheap ETF when it comes to the expense ratio. It is also only 0.03%. So also a very, very low cost ETF on its own. And if we go down, you are going to see pretty much the same thing as before, that this ETF is going to be very weighted toward information technology. There are a few more probably sector diversifications you see here because of its investment methodology, investing in small, mid, large, and mega cap companies. But all in all, you pretty much do have an ETF that mostly is in line with the S&P 500, of course, because it tracks these by market index. And of course, as we remember, the top 10 companies are the largest companies. So you're pretty much going to see that all of these holdings in the top 10 are going to be the exact same as the ETF VOO that we just reviewed. And a lot of people don't really care for this ETF because they say that a big portion of the US economy is in the S&P 500. And because you're investing into VTI, it doesn't really do much for diversification, just because the S&P 500 is pretty much like 80% overlapped with this ETF as it is. And then since equities kind of rise and fall in line, whether they be mid cap or small cap compared to large cap, is this ETF really worth it? Why not just VOO? And I think you'll see by our back test later that this ETF is kind of pointless maybe, and this extra diversification is kind of irrelevant overall. Anyway, pretty solid ETF though. If you do want a total market ETF, you're going to touch on, again, the small, mid, and large caps, unlike a simple S&P 500 ETF, which doesn't do that at all. And the final ETF is VT, the Vanguard Total World Stock ETF. Now we're starting to get into some diversification because this ETF tracks companies globally. And I at one point did own this ETF, and I was actually a happy owner of it. I didn't really find too many problems with it if you understood that companies outside the United States may not perform as well as the S&P 500 during some times, but then that kind of goes back and forth because there might be some times that the companies outside of the United States perform better. But I basically sold this ETF because I own so many other ETFs, and I found that this ETF was kind of unnecessary diversification because I just didn't want to own it just by itself. So this invests in both foreign and US stocks, of course, as I said before, and it seeks to track the performance of the FTSE Global All Cap Index, which covers both well-established and still developing markets. And this ETF has a bit of a higher expense ratio, sitting at 0.07%, so it is higher than the previous two. And some people artificially create this ETF by holding something like VTI or VOO and then VXUS, and that is definitely something that people can do if they want. That will give a slightly lower expense ratio holding those two together, and then it also allows for investors to kind of pick how much exposure they want to ex-United States companies. So if they want like 50% exposure outside the United States, they can do that. If they only want something like 10% exposure, they can do that as well. I'm not really going to discuss that here because the intent of this video is to choose one ETF alone. And obviously, if I am talking about holding VTI and VXUS, that is 2 ETFs. So can't really do that when the intent is to hold only one. And I think when it comes to the total diversification, you are going to see an incredible number of holdings. We almost have 10,000 different stocks in this ETF. So it's going to touch on pretty much every segment of the US market and then also every segment outside of the United States. And we are going to see if we can find some country diversification down here. So pretty much most of its holdings are in North America. So things like the United States, Canada, and Mexico. I'm going to assume that Mexico and Canada's holdings pale in comparison to what's in the United States. Then you have Europe, Pacific, and emerging markets after that. So you definitely do see a large segment of the global economy as a whole looking at that. And the thing is that this ETF is still very much in line with the S&P 500. If you do remember those prior holdings, we still do see many of those holdings in this ETF as a top 10. But I want you to pay attention to an important thing here, and that is the weightings of these top 10 now. So like Microsoft, it only accounts for about 3.8%, Apple about 3%. And if I go back to VOO, you see that these stocks are much more weighted heavily by several percentage points overall. So you still do get those top 10 pretty much very similar, but the weightings are of course a lot less. And you would expect that because this ETF holds so many stocks as a whole. So very good ETF, again, if you just want to VT and chill, as they would say, and you want to be exposed to the entire globe itself. So let's talk a little bit about historical performance. This is going to go back to about 2010. And pretty much what you'll notice right off the bat is the blue line. And that blue line is the Vanguard Total World Stock ETF, VT, which is that ETF we just spoke about. And you'll see it underperform these two other ETFs, VTI and VOO, very significantly. And that is because of the United States doing a complete bull run this previous decade. It has completely outperformed these companies outside of the United States. So definitely keep in mind that had you have held this ETF during this time, you would have underperformed, but there's no guarantee that that is going to be that way going forward. Of course, a lot of people say that the United States is pretty much like the golden nugget of the world when it comes to money, and I also agree with that. But anything can pretty much change. There are years that aren't showing on this back test where international markets outside the US have performed a little bit better. Now, if we look at the performance against VTI and VOO, that's kind of what I was saying before. They're very much similar, so a lot of people don't even really care to hold VTI. That extra diversification doesn't really help you out that much. You almost see no benefit to that diversification. If you noticed, the best years here are pretty much in line, and the worst years are also pretty much in line too, with the max drawdown and the standard deviation. I guess the S&P 500 may be even a little bit less volatile than VTI, probably because it doesn't include those small cap stocks in there. So it's kind of up to you which one of these to hold. Personally, I don't think it makes too much of a difference. I would probably just go with the S&P 500 because you're getting the 500 largest companies as it is, and what those smaller companies provide probably would not help out if you just put it into VTI. The results are pretty much going to remain mostly the same, in my opinion. So tell me what you think about this single ETF investment style. Tell me if you do it, or if you don't do it, why don't you do it, in the comment section below. And remember, if you do appreciate this content, give this video a like and also subscribe for future content so you could hear about more ETFs and also go along with me and track my net worth and investment portfolio if that's something you're interested in. And I'll see you all in the next video.